All right, joining us for a chat is our mortgage guru, Clinton Wilkins. Clinton, always great to chat with you, my good friend.
Nice to chat with you as well.
Indeed. All right, I want to get to this mortgage-free retirement story, but quickly, the Nova Scotia Power thing and the tie-in with you, of course, is credit, and you've always been a strong advocate of people should be monitoring their credit anyway, correct?
100%. I think credit monitoring is very, very important, especially in today's day and age. There's so much fraud happening. It's really a lot on an uptick. There can be security issues around things online, data breaches like what happened with Nova Scotia Power. Consumers can pay for credit monitoring from both Equifax and TransUnion. It is important to monitor both, but there are a couple of free apps out there, Todd, that people can subscribe to. There's one called Borrowwell, which ties in the data from Equifax, and Credit Karma, which brings in the data from TransUnion. Those are free apps. You can download them from the App Store. You do need to give them all your personal information. And they're going to try to sell you some credit products, from different banks. That's how they monetize and how they make money. But I do have these apps personally, and I know a lot of consumers do use them. So if you don't want to pay for credit monitoring, or if you don't have access to a free credit monitoring service, I would definitely check out those free apps.
Okay, so people listening right now who might not even been impacted by this might be an opportunity to kind of kick you in the rear end and do this because it's prudent anyway, obviously. What is your core message here?
Exactly. And there's going to be small changes to consumers' credit, throughout the month, month to month. It's very, determined by obviously repayment history as well as utilization. Those are kind of the two biggest impacts on a consumer's credit. There are also many different credit factors. So, I would say monitor your credit, especially if you're planning on doing a big transaction, i.e. maybe changing jobs, getting an apartment, obviously buying a home and getting a mortgage, getting a car. There's many things in people's lives that are impacted by their credit and their credit history. So it's certainly good to be monitoring it. And there oftentimes can be errors on there that can be corrected. So monitor your credit. And if you do find something that's not right, then take the action to correct that.
Okay, fair enough. All right, this story, I saw it on the Global News website. A third of Canadians approaching retirement in the next couple of years expect to keep paying their mortgages after they've stopped working, this according to a new report from Royal LePage. And this is something that you and I have talked about a lot on Mortgage 101, and this is becoming a lot more common, isn't it?
Certainly is. I would say that about a third of our clients are in retirement age, Todd. Many consumers, the biggest asset that they have is their home. So we have a lot of clients that even pre-retirement will sometimes mortgage their house or refinance their home or put on a home equity line of credit. Very, very common for a consumer to do that. And I think a lot of the consumers that we're seeing that are entering retirement or even pre-retirement or already retired are taking longer amortizations. They're taking amortizations at 25 and 30 years. And the way that they look at it is they've worked hard all their life and their home is their biggest asset, but they're supplementing potentially their pension income to help live a better quality of life in retirement and leveraging that asset. So it's very, very common. I would say it is less common for retirees to then focus on really still trying to pay it down. Obviously, when you're retired, you have typically a smaller amount of income. And I think, most retirees want to have a good quality of life and they're using their home to help that make that happen.
And is there kind of a paradigm shift when it comes to people and a mindset? Because we know that the previous generations, it was get that paid off, and that was considered a key component to being retired and part of your retirement plan. That's kind of changed, or not kind of changed. I think there's a shift in philosophy with all of this in general.
Canadians in general have a much higher tolerance to indebtedness, Todd. So I think that culture across the board has changed. But I think for retirees specifically, the cost of living is very high, but they've also received such a huge increase in their net worth with the increase in the property values. So I think they're thinking about this, that home that was once worth, $250,000, $300,000 is now worth $600,000. And they're thinking to themselves, well, I can leverage the difference of this increase and live off of this money, improve my quality of life, pay down unsecured debt. And a big one is they are providing large gifts to their kids to help them enter the housing market. The average gift right now across the country that we're seeing, for gifted down payment is somewhere almost in the $100,000 range that parents are gifting to get kids into homes. So that shift has really changed. When I first started doing this 20 years ago, almost 21 years ago, the average gift was $5,000, $10,000, $20,000, $25,000 maybe. But there's been a major shift in the last 5 years with family gifts and helping kids get into the real estate market. And oftentimes the kids need these size of gifts to be able to qualify, Todd. That's the biggest challenge because the real estate prices have gone up quicker than the income from these consumers.
All right. So, and are they leveraging money from their savings, or are they leveraging money from their equity in their home in order to give that gift?
I think it's both.
Yeah.
And I think the ones that are leveraging equity in their home, they're seeing themselves that their, value of their home has doubled in the last 5 years, we'll call it. Yeah. And they say, okay, if I do not give a gift to my kid now, they may never be able to get into the housing market.
Right. Okay, so you're sitting there and you may have $100,000 left on your mortgage, and although now, like you said, your home is worth $700,000 as opposed to when you bought it 3 or 4 or whatever it is. So carrying that debt, servicing that debt in a mortgage, low interest mortgage, is pretty easy financially and fiscally. And you know that at some point when you when you pass on or when you sell or whatever, that money's coming your way. It's like money in the bank, I guess, is right, having that equity.
It certainly is money in the bank for sure. And, there certainly has been a big uptick in reverse mortgages as well. You always hear about the Canadian Home Income Plan, and that's, that historic one that you remember the commercials and seeing them on TV. It's a great way for retirees to be able to leverage the equity in their home and supplement their income. And, really putting a mortgage on the home, whatever style it is, whether it's a HELOC, a reverse mortgage, or traditional mortgage financing, the real goal is to keep people in their homes, Todd. Yeah. And this cost of financing is a lot less than the cost of rent. A 2-bedroom unit in Halifax, the average rent is around $2,500. And the cost of borrowing for all of these products, obviously depending on how much they're drawing down and how much they're borrowing, is typically a lot less than $2,500. So the way I think consumers are seeing it is, hey, I can leverage my home for whatever reason the outcome needs to be, but the actual cost to service that debt is a lot less than paying rent.
Yeah, what are your thoughts on kind of this generational divide, almost generations being pitted against each other, those that have equity in homes and those who don't and on the outside looking in? What are your thoughts on kind of that generational divide that we're seeing in this country right now?
Well, I think it's the biggest generational wealth transfer is what we're seeing right now, Todd. The boomers are passing away and passing their net worth down to their kids. It's going to be interesting to see what happens with the next generations because obviously the culture is changing. But even when we're thinking about things like multi-generational housing, that was very popular, then it became unpopular, and now it's becoming popular again, obviously just due to the cost of housing and the cost of really just operating a household in today's, economic situation. So I think there certainly is a shift around that culture, and it'll be interesting to see what happens again in another 25, 30 years.
Yeah, and in general here in Halifax, the trend is what when it comes to the housing market is you've often said on the show and you talked about it that you feel as though that we've not been in a bubble here in Halifax. That Halifax is not in that circumstance that's been described in Toronto and Vancouver, in particular the condo market. So you still feel that way?
I 100% feel that way. The market's stronger than it ever has been here in Halifax. Our number one issue, Todd, though, is still supply. Yeah. We are not having enough listings, and there's too much demand in the marketplace. So we're still in that seller's market. And, I think part of it was, we said this before, the little old lady and the little old man that really do want to sell their home for whatever reason. They didn't have another home to go to. Right. But now we're seeing more and more apartment starts. And I think when we see more of these online, it's going to help us rebalance the resale market in terms of homes, but we still need to really be working with all levels of government to get those shovels in the ground and get more housing starts going. And it's all types of housing that we need. Yeah, for sure. All right, Clinton, always great, my friend. Appreciate it. Look forward to chatting for our Teeing Up a Mortgage 101 in June. Thanks, my friend. Excellent. Thanks, Todd. Okay, pal. Have a great day. Take care. Clinton Wilkins, our mortgage guru.